Dan, let's talk about Apple. How do you play that from an options point of view?
Sure. I think it is safe to say that the Q2 that they're going to report is kind of baked in the cake here. The stock has been pretty range bound. It's actually down 5% in the year versus the NASDAQ, which is almost back unchanged on the year. So it's demonstrating the underperformance that Apple shareholders have gotten used to over the last 12 to 18 months. The options market is implying about a 3.5% move in either direction tomorrow. And you do the math, that's like a $16 billion move. When you think about it, how many companies that we invest in or trade actually have $16 billion market caps. Now, obviously, a lot of them in the AAP portfolio do, but that's a big, big move, and it's going to come down to the guidance. And here's the thing with Apple, they're not going to tell us about products. So when you want to know what's next, we're not going to find that out on the call. And I think a lot of investors are now, and I think probably properly focused on the capital redistribution. And so they had that shareholder meeting in February. We have not heard a peep since they did the accelerated buyback of $14 billion worth of shares. For the next couple months, it's about capital, capital reallocation, and then we need to get some information on products. And that's the thing. Just this week, and you and I were just chatting about it offline here, it seems that the wagons are circling for Tim Cook's head. iPhone 6 needs to be a smash hit. Not like the 5S and the 5C, but we won't know until probably September. So in the meantime, how do you play it with options? Implied volatility, the price of options is actually really low. So it's not a great candidate for adding yield by selling calls against the stock that you own. But if you're looking to add maybe some leverage to the position, you believe that there's going to be something that comes out, maybe a wearable device that will move the needle, then you may want to look to add some leverage to your long position with calls. They're pretty cheap.
So you do that now, right? Or do you want to wait maybe until the summertime because these products really aren't coming out until, say, the fall?
I think you do. I mean, I think the stock is going to be range bound because of all the reasons that we just said until you get some glimpse, until we get some really good leaks about the new products, and that's probably going to happen in the summer. In the meantime, though, I think you have a range. The company started buying the stock aggressively on that accelerated buyback after the last quarter's earnings between 485 and probably 510 or so. That was the range. I think a lot of people think psychologically that's a really good support level. If the stock dips on weak guidance and maybe a buyback that people think is less than they were expecting, then maybe you buy the stock at 500-ish because you know that the company's a buyer down there.
And from a fundamental point of view, that's actually the price where we would want to buy it in Action Alerts Plus. So from an options point of view, this is another option to do it, as you're saying, and to capture that trading range in the meantime.
Yeah, and I would make one other point. Because this company has actually demonstrated that they're willing to buy stock and buy it aggressively and in the tens of billions, that's actually vol dampening, meaning that it actually makes the price of options less than most other companies that are not actively buying the stock. So the options are going to be cheap overall, which don't make them a great candidate. A lot of you guys out there like to overwrite stocks that you own to add a little yield. It doesn't make it a great candidate for that, but what it does do when the stock comes down to a certain level and you think the company's going to be buying, it does make call options relatively cheap.
Fabulous. Thank you so much.
Sure.